No day trading strategy has a guaranteed high win rate across all markets, and win rate alone can be misleading. Some strategies win often but have small profits and occasional large losses. Others win less frequently but produce larger gains. That said, a few approaches are widely used because they tend to produce relatively consistent setups when applied correctly. The opening range breakout, ORB, is a day trading strategy built around the idea that the first minutes after the market opens establish an important price range. This period often reflects institutional positioning, overnight news reactions, and the highest liquidity of the day. When price breaks out of that early range, momentum can continue in the breakout direction. What the opening range is. The opening range is typically defined using the first 5, 15, or 30 minutes after the market opens, 9:30 a.m. Eastern Time for U.S. equities. Traders mark two levels, opening range high, opening range low. These become key intraday support and resistance levels. A break above the high suggests demand is overpowering supply. A break below the low suggests sellers are in control. Why it works. Large institutions often execute orders at the open because liquidity is highest. Their buying or selling pressure can create directional bias for the rest of the session. If price breaks out of the early range with strong participation, it may indicate continuation rather than random noise. Basic long setup 1. Wait for the market open. 2. Mark the high and low of the first 5-15 minutes. 3. Watch for price to break above the range high. 4. Confirm with strong volume. 5. Enter long on breakout or first pullback. 6. Place stop loss just inside the range. 7. Take profits at risk multiples or key levels. The short setup is the same, but in reverse when price breaks below the opening range low. Best time frames. Most traders use 5-minute chart to define the range, 1-minute chart for entry timing, optional 15-minute chart for broader context. Shorter ranges, 5-minute, produce more trades but more false breakouts. Longer ranges, 15 to 30 minutes, produce fewer but often stronger moves. Indicators commonly used. Volume confirms participation during breakout. VWAP helps confirm overall trend direction. 9 EMA or 20 EMA assists with pullback entries. Relative volume RVO identifies stocks with unusual activity. Entry variations. Breakout entry. Enter immediately when price crosses the range high-low with volume. This is aggressive but captures more momentum. Retest entry. Wait for price to break out, then pull back to the range level and hold. This is more conservative and often higher probability. Momentum candle entry. Enter only if breakout candle closes strongly above the range. Stop loss placement. Common options, just inside the opening range, below the breakout candle low for longs, based on ATR or fixed risk amount. Tighter stops increase win rate, but can be stopped out more often. Profit targets. Traders often use no 1-1 or 2-1 risk to reward, previous pre-market high-low, whole number psychological levels, trailing stop using moving average. Some scale out, sell part at first target and hold the rest. Best conditions. Opening range breakout works best when stock has news catalyst, earnings upgrade, etc. High relative volume, strong pre-market trend, market indexes trending in same direction. It works poorly in low volume days, choppy markets, inside days, very small opening range, major reversal mornings. Common mistakes. Entering before breakout confirmation, ignoring volume, trading wide ranges, too much risk, chasing extended moves, not aligning with overall market direction, e.g. S&P 500 trend. Typical win rate expectations. Well-executed ORB setups often aim for roughly to 65% win rates depending on entry style. Retest entries tend to be higher probability but fewer trades. Aggressive breakouts may win less often but capture larger moves. Example workflow 1. Scan for stocks with high pre-market volume. 2. Watch at open and draw first 5-minute range. 3. Wait for breakout with strong volume. 4. Enter on pullback to breakout level. 5. Stop inside range. 6. Take profit at 2R or trail. The key is patience. Many traders only take one ORB trade per day when conditions are ideal. VWAP stands for Volume Weighted Average Price. It represents the average price a stock has traded at during the day, weighted by volume. Unlike a simple average, VWAP gives more importance to prices where more shares were traded, which makes it useful for understanding where the majority of participants are positioned. Conceptually, VWAP shows fair value for the session. If price is above VWAP, buyers are generally in control, and most traders who bought earlier are in profit. If price is below VWAP, sellers dominate, and many long positions are underwater. Because of this, VWAP often acts like dynamic support or resistance. Institutional traders use VWAP as a benchmark. Large funds try to buy below VWAP or sell above it to achieve better execution than the average market participant. Since these large players move significant capital, their behavior tends to reinforce VWAP reactions. This is why price often bounces near VWAP during trends. How traders interpret VWAP depends on context. In a strong uptrend, price opens above VWAP and stays above it. Pullbacks to VWAP are often viewed as buying opportunities. In a strong downtrend, price stays below VWAP and rallies into it are often shorting opportunities. When price crosses back and forth through VWAP repeatedly, the market is considered choppy or range-bound. A typical long setup works like this. The stock gaps up, holds above VWAP, and pulls back toward it with decreasing volume. When buyers step in near VWAP and price starts moving upward again, traders enter long. The stop is often placed slightly below VWAP. The idea is that if price decisively breaks below VWAP, the bullish bias is invalidated. A short setup is the opposite. Price trends below VWAP, rallies toward it, stalls, and then resumes downward. Traders enter short near VWAP, expecting sellers to defend that level. There are also VWAP cross strategies. When price moves from below VWAP to above it with strong volume, some traders treat that as a shift in control from sellers to buyers. This can signal a trend change, especially early in the day. However, crossovers in low volume conditions can produce false signals. Multiple VWAP extensions are sometimes used. Standard deviation bands above and below VWAP help identify overextended price. If price moves far above VWAP, traders may expect a pullback toward the mean. This is called a mean reversion approach. It works best in range-bound markets, not strong trends. Time of day matters. VWAP is most reliable after the first 15 to 30 minutes, once enough volume accumulates. Early in the session, it moves rapidly and can be less stable. Midday, VWAP often becomes a magnet where price oscillates. Late in the day, institutions may rebalance around VWAP again, increasing its influence. VWAP is commonly combined with other tools. Traders often pair it with short-term moving averages like the 9 EMA and 20 EMA to refine entries. Volume confirmation strengthens setups. Some also check broader market direction using indexes such as the S&P 500 because individual stocks tend to follow overall market flow. There are also anchored VWAP variations. Instead of starting at market open, anchored VWAP begins from a specific event, such as an earnings release or major breakout. This helps traders see the average price since that catalyst, which can act as support or resistance over multiple days. Common mistakes include trading VWAP in extremely low volume stocks, assuming every touch will bounce, and ignoring trend context. VWAP is strongest when aligned with momentum and weaker when price is choppy. In practice, many day traders treat VWAP as a dividing line. Above it, they prefer long trades. Below it, they prefer shorts. Combined with volume and trend structure, it becomes one of the most widely used intraday reference points. The 9 EMA and 20 EMA are short-term exponential moving averages used to track momentum and trend direction in day trading. An exponential moving average gives more weight to recent prices, so it reacts faster than a simple moving average. Because of that responsiveness, short EMAs like 9 and 20 are popular for intraday decisions. What the 9 EMA represents. The 9 EMA tracks very short-term momentum. It hugs price closely and moves quickly when price changes. Traders use it to identify immediate momentum, time precise entries during trends, spot quick pullbacks. In a strong uptrend, price often stays above the 9 EMA. When it pulls back to it and then bounces, that is seen as buyers stepping in early. In a downtrend, price often respects the 9 EMA from below. What the 20 EMA represents. The 20 EMA is slightly slower and reflects the short-term trend rather than immediate momentum. It acts as a deeper pullback level. When price retraces to the 20 EMA and holds, it suggests the overall trend is still intact, but momentum temporarily cooled. Many traders treat 9 EMA aggressive entry level, 20 EMA's conservative entry level. How they work together. The space between the 9 EMA and 20 EMA shows trend strength. Wide separation, strong trend, momentum is high. Narrow separation, trend weakening or consolidating. Crossovers, possible trend change. If the 9 EMA stays above the 20 EMA, the trend is considered bullish. If it stays below, bearish. A crossover where the 9 EMA moves above the 20 EMA signals potential upward momentum. The opposite signals potential downside. Pullback strategy using 9 EMA and 20 EMA. In an uptrend, 1. Price moves upward strongly. 2. Price pulls back toward 9 EMA. 3. If it bounces, traders enter long. 4. If price breaks below 9 EMA, they watch 20 EMA. 5. Bounce at 20 EMA is still considered healthy trend continuation. Stops are often placed slightly below the EMA used for entry. Trend strength interpretation. Price riding the 9 EMA. Very strong momentum. Price between 9 and 20 controlled pullback. Price breaking below 20, trend weakening. Price below both, possible reversal or consolidation. Best time frames. These EMAs are most commonly used on 1-minute chart for scalping entries, 3-minute chart for smoother signals, 5-minute chart for trend confirmation. Many traders combine them. Use 5-minute chart to confirm trend direction. Use 1-minute chart for entry when price touches 9 EMA. Common entry types. Aggressive entry, buy when price touches 9 EMA and shows rejection. Conservative entry, wait for pullback to 20 EMA. Crossover entry, enter when 9 EMA crosses above 20 EMA with volume. What makes a good setup? EMA sloping clearly upward or downward, strong volume on trend moves, clean pullbacks, not choppy, price respecting EMAs multiple times. Common mistakes. Trading when EMAs are flat, no trend. Taking entries after price is far extended from 9 EMA. Ignoring higher time frame direction. Using them in low volume conditions. Why 9 and 20 specifically? These numbers strike a balance. 9 is fast enough for intraday momentum. 20 is slow enough to filter noise. Together they create a short-term trend channel that many traders follow, which can reinforce their effectiveness due to collective behavior. When both EMAs align with volume and overall trend, they often provide some of the cleaner continuation entries in day trading.